So this is how people can get in trouble too, because someone could come in as a tourist, not go back home and stay in the US, and because of the day count test may trigger the substantial presence test, and oops, now they are a US tax resident.
Welcome to the US-UK Tax Talk podcast. I'm thrilled to be joined by Alicea Castellanos, founder and CEO of Global Taxes LLC. Alicea has been providing US tax advisory and compliance services for over 20 years, and so she's absolutely the best person to be talking to about this topic. We hope you enjoy the episode. Good morning, Alicea. How are you?
Hi, good morning, Aidan. I'm good, thank you.
Thank you so much for joining me today. I'm really looking forward to this episode. You're dialing in all the way from New York.
Yes, all the way from New York.
It's so nice. It's so nice to have someone in the US part of the world when we're talking about US-UK things. So thank you so much for joining me. As I sort of trailed at the beginning of this episode, you very kindly come on today to help me understand and the listeners understand this concept of the US tax residency rules, which I will be entirely honest, I've been wanting to do for about 3 years because I always talk to Americans about residency status. And in the UK, we have a set of rules. We follow them, and either you are a resident or you are not. And it seems to me a complex rule, but it's straightforward. But in the US, you've got so many different rules that dictate how you're resident and who's a resident, and you can be a resident despite the fact you don't live in America. And so I really want to take the opportunity to go and just sit down with you and understand what the heck are these residency rules and how do people kind of get on top of them. So thank you so much.
They can be confusing. Yes, for sure. Mm-hmm.
So to the listener, to signpost what I think is going to be a really interesting discussion, the first thing I want to pick Alicea's brains over is, what does it actually mean to be US resident? What are the different ways that we can be a tax resident, specifically a tax resident, as opposed to, say, resident for immigration purposes? And then what are the consequences of being a resident as opposed to being a non-resident on your exposure to US taxation? And then we're going to look at if you want to try and get out of being a resident and the various ways you can stop being a US resident. And at the very end, hopefully, we're going to have time to look at, well, what if you're a resident in both countries at the same time? Because shock and horror, it is possible to be a resident of the US and the UK at the same time. And gosh darn it, what do you do about it in those circumstances? So, Alicea, if I can sort of tee you up with that first question, the obvious answer to both, I think, you and me as professionals in this space, there is a distinction between being a tax resident and being a resident for immigration purposes. Is it the case, like in the UK, that the IRS and your sort of Homeland Security will take quite a different view as to whether you're a resident for immigration or tax purposes?
Yes, that's exactly what's going on in the US as well. So in the US, basically, so the immigration rules and the tax rules are a little different. Yeah. So you could be a tax resident, which is what we're talking about here, and not be, I would say, a legal immigration resident in the United States. So we have a lot of, say, tax residents in the United States that are not documented, meaning that they don't have a visa, they don't have a green card, they're not U.S. citizens. So when we're talking about U.S. tax residents, it's really under the taxation laws. So a U.S. tax resident, and usually when professionals talk about U.S. residents, they're talking about tax residency. So who is a U.S. tax resident? A U.S. citizen is automatically a tax resident.
I just have to jump into cite what I think is the stat I use all the time. There's only one other country in the world that has that same rule?
Yes, it's another country. It's an African country. I think it's called
Eritrea?
Eritrea, yes.
Yeah.
And I think I read somewhere that they consider all of their citizens tax residents and they're taxed on worldwide income because the population is very low.
Yeah, so the combination of the 14th Amendment in the US, that means that everyone that's born on US soil is an American, and people like, well, actually not me, my brothers who were born to American parents outside the US are Americans. That's a lot of people that are considered tax residents in the US.
Yes, a lot of people, and actually some of them don't know, or they never, really looked into it. And so we have so many Americans living overseas, and similar to your situation, the parents may have been or American, and they are American as well, but because they've lived overseas all of their life, they never really got preoccupied with finding out what they needed to do in the US. And so sometimes I even have some clients that are looking to get a visa to come to the US, and then they're told, oh, but you don't need a visa. You are a US citizen. So they find out that way that they are US citizens, and now they have to file tax returns and correct their US tax compliance because, as I said earlier, once you are a US person, a US tax resident, and a US citizen is a tax resident, then you have to file tax returns. Not necessarily pay taxes, but the government, they want that piece of paper. They want to know what's going on with you.
Is it fair to say, I mean, in its most general terms, because I'm sure if we get into the specificity, there may be a distinction, but it really is the case that if you are an American citizen, whether or not you have a US passport, but you are sort of entitled to American passport because by virtue of your birth or where you were born or your heritage, you are exposed to the same federal taxes on an income tax basis as someone who is a resident of the US by virtue of their time spent there, which we'll come to in a bit. There really is no distinction between being a citizen and a physical resident of the US.
For income tax purposes.
Correct, for
no.
income tax purposes, yes.
Yes. So now you did mention there's another kind of resident, or someone who would be a resident depending on some other rules, not citizenship and not a green card. And I don't know if I mentioned this, but a green card holder would be a tax resident.
And is that irrespective of how long you've held your green card? Because I know there are certain rules about that you get more introduced into the US tax code the longer you've held your green card. But for US income tax purposes, am I a US resident as the moment I've got my green card, even if I left the US but hadn't rescinded my green card?
So it's interesting with the green card. So basically, if you get a green card and say you entered with the green card and you were not in the United States before, then yes, you become a tax resident automatically when you use that green card to enter the United States. So from that time on, from that date on, you will be a tax resident unless you take a position that would not make you a resident, like a tiebreaker position or
Which
something
we'll come
like
to.
that.
But that means that if I've been in the US for a couple of years and maybe I acquired my green card, and let's say I've returned to the UK and I haven't formally given back my green card, it's sitting in a drawer somewhere, as far as the American government is concerned, I am still a
Correct.
US tax resident for income tax
Correct.
purposes.
You still have to file income tax returns and informational returns like the foreign bank account report to report your non-US financial accounts. So you would still, it doesn't matter where you are in the world, if you have not formally given up your green card, meaning returned it to immigration, you would still be considered a tax resident.
Do you find, I mean, citizenship, maybe there are people that do understand that by virtue of being a citizen, unusual though it is, that means that you are a US tax resident. Do you find that you come across people frequently who are green card holders and haven't formally gone through the process of giving it back and don't realize that they are still US tax residents?
I always come across with people who have their green cards and they say they move overseas and they are happily living overseas, still with a green card. They have not returned it to immigration. And they think that just because they left the US, they no longer have US tax return filing requirements or FBAR filing requirements. And all of a sudden, they come across me and I tell them the bad news and I become persona non grata. I'm giving them bad news. But, there are ways to correct that. So some people who haven't been filing and were required to file, the government has some programs, especially for people living overseas, to come back into compliance. And then we also have, say, for example, some people who just want to give up their green card. They left because they didn't have to come back or didn't want to come back, and because they wanted to live somewhere else, and they have made a home somewhere else, and so there's a process also to giving up their green card, depending on how long they've had the green card. But yeah, that's very common.
I think we'll come to later on what do we do if we want to give up being a US tax resident based on which of the various criteria we're caught by. The part that I actually wanted to talk to you most about, because citizenship and green card are fairly binary, either you have them or you don't, is what I believe you refer to as your substantial presence test, which is the part that most similarly resembles the UK statutory residency test. It's an SRT versus an SPT. So this is the test, correct me if I'm wrong, I believe, the one that says you may be a tax resident depending on how much time you spent in the US over a period of time. So for those that aren't citizens and aren't yet green card holders, can you talk to what the substantial presence test is and how an individual goes about trying to work out whether they've triggered the rules?
Yeah, okay, sure. So the substantial presence test is the technical name to what we normally call the day count test, very simply. And that's what most taxpayers know it as, the day count test, because they need to count their days. And so what does that rule say? It says that, well, it's a test. It's a test of the US days that someone has been in the United States. So say that we're looking to see if someone is a tax resident for 2024. So we would look at that in 2025 and we would check, okay, how many days was this person in the United States in 2024? So we take 100 days under the rules, under that test, we take 100 days of the US days in 2024. And then we also add 1/3 of the US days in the second preceding year. So that will be 2023. So we take 1/3 of the 2023 US days. And then we take 1/6 of the days of the second preceding year to 2024. So that will be the US days in 2022. And if the total is more than 183 days, then they are going to be considered US tax residents for US tax purposes.
You can't just look at a particular year in isolation. It's actually about how long you spent over kind of a 3-year rolling basis.
It's a 3-year rolling basis. And also the first year, you also must have spent 31 days in the US, more than 31 days. So
right.
You could actually be meet the substantial presence test and not have spent so many days in the US in that year. And there are ways to get out of having to file tax returns in the US if that's the case.
So does that mean in practice, in my first year, I arrived fresh-faced, at Ellis Island in the US as a person who's not a citizen, not a green card. I'm just an immigrant to the US for the first time. If I keep my days below 183 days, and I've not spent any time in the US in the prior 2 years, does that mean I won't then be a US resident in that first year?
Correct.
But then, of course, in the subsequent years, I'm going to get some of those days, half of them or 6 of them are going to get added in. So it's going to be more impactful in future years and harder to avoid being resident. But in that first year, the US, actually, compared to the UK, for example, is actually a lot more generous about allowing you to be in the US without being a tax resident.
Right. Yeah. So the first, if you haven't been in the US for the last 2 years and then you come in year 3 and you spend less than 183 days, then you wouldn't be considered a US tax resident. Now, even if you do go beyond that, but you have a special, I'm calling this a special visa. There are some visas where you can stay in the United States for as many days as you wish, even the entire year, 365 or 365 days, and you wouldn't be considered a tax resident. So that would be someone that, say, has an F1, which is a student visa. That's just an example of someone who can be in the United States for more than 183 days and not be considered a tax resident.
If they come off that visa, does those days spent present in the US on the visa count towards their day count?
Not in the future, but if they have the visa for more than 5 years, year 6, even if they are on an F1 student visa, then they will be considered tax residents.
So I can't sit on a part-time 10-year course and sit for years and years and years on my F1 visa. The government is sophisticated enough to know that's not going to work eventually. I mean, it is interesting because I get this question quite a lot from Americans who come to the UK either as students or looking for some reciprocity for the similar process with US visas. And I say the UK doesn't have any kind of carve out in the way the US does. So if you're a student here in the UK and you trigger our rules because you exceed our day count test, you are a UK tax resident. There is
Oh
no
no, so there are no
carve-out. So
exceptions.
no,
Oh,
if you're working part-time and you generate income and that income exceeds your taxable threshold, subject to reliefs under a treaty, and we're going to come back to what that looks like, you are exposed to UK taxation. You may be required to pay UK tax. And so I think it is a distinction the US does on the kind of day count merits. The US does appear to be more generous in who it lets slip through the net, as opposed to the UK, who are really much more sort of tightly controlled as to who they'll allow. It's a reflection
right.
I've often wondered, and I'm pleased to hear you elaborate on what I thought was the case, was these sort of special rules where I've heard people say, oh, I'm a student in the US.
It's pretty sophisticated, and then also, I mean, and then also, this is how people can get in trouble too, because someone could come in as a tourist, not go back home, or and stay in the U.S., and because of the day count test, may trigger the substantial presence test, and oops, now they are a U.S. tax resident.
Yeah.
And many people have done that, right? That's why we have an immigration problem in the US. People come under a visa, a tourist visa or something like that, and then they overstay the visa and they start working. And now, for tax purposes, they become tax residents, but not legal immigration. Under immigration, they don't really have a status,
The IRS is going to be all too happy to continue
Yes,
to
but
take tax from them.
The IRS wants to collect their tax, and a lot of people, undocumented persons, file tax returns.
Going back to the day count test, when you talk about being in the US, just to be absolutely clear, to distinguish it from the UK, we're talking about days spent, a day count on a calendar year basis, because that's the US tax year, as opposed to in the UK, where our tax year starts on April 6th and ends on April 5th.
That's correct,
So
yes.
if I come to the US for the first time, let me ask you this question in the way that perhaps a client would ask you this question. If I come to the US, let's say I come to the US on September 1st, because my children are starting in school, or I'm starting a new job and it starts September 1st. If I've not been in the US at all in the previous 2.5 years, and I come and start living in the US on September 1st, there is no way that the US can tax me as a resident in that first year, because I simply don't have enough time to build up enough days to become a tax resident in that first year. Is that the case?
Yeah, I mean, you could be a dual status. So meaning that if you did move to the US in September, it's possible the first year you're not a resident, because under the substantial presence test, you wouldn't meet the day count test. So for someone like that client that moves on September 1st, never been in the United States before that date, they would not meet the substantial presence test. They would file a non-resident return just to report their U.S. sourced income. And then in the next year, they would be considered, if they are still in the U.S., they would be considered tax residents.
It doesn't matter how strong their nexus to the US is, it is merely the days spent. Because in the UK, it is theoretically possible. It is hard, but I could generate a scenario for you on a factual basis where even one day spent in the UK on the final day of the tax year, that could cause you to be resident for the entire year. It's
Right.
incredibly unlikely,
Yeah.
but it's not possible in the UK to have that same kind of general rule.
Yep. Yep.
Does that mean then, let's say, for example, what I imagine you spend a lot of time talking to clients about, and I spend a lot of time talking to clients about, is pre-arrival planning. If my client is coming to the US for the first time, and I'm thinking about carrying out steps prior to becoming a US tax resident for the first time, and they want to arrive on September 1st, let's say, they can actually be carrying out those steps while physically present in the US, because they know with comfort that they're not going to become a US tax resident until the 1st of January. So they can do these things as a non-resident, despite the fact they are already at this point physically present in the US.
Correct. Mm-hmm.
Interesting.
Yeah, I mean, we also have situations where, say, someone, it's the first year in the US, they came in early during the year, and they're like, oops, I'm going to have a huge liquidity event at the end of the year. And they still have time to leave the United States and not be tax residents.
Yeah.
So it needs to be we need to catch it early on.
And let's say in this scenario, so your client isn't coming in September, but your client is coming in February or March. And so enough time that you could have 6 months here, but also enough time to kind of come out and come back, and so to plan for it. Let's say the first day that the client comes in is March 1st. But they do spend 6 months of the year in the US. will the IRS treat their US residency start date as the day they first entered the US, or they treat it as January 1st being the start of the tax year?
Yeah, no, that's a good question. So start date of of their tax residency would be the earliest of. So if they come in with a green card, the day they come in with a green card, but in a situation where they're not US citizens, if they are US citizens, obviously it's going to be January 1. We're not talking about those situations. Green card holders, it will be the time, the dates that they come in with that green card, or if they're in the United States, if they received the green card in the US, the earliest date of when they received the green card, or if they were in the US before that date, that earlier date, which would be the substantial presence test date, right? But now going back to the substantial presence test, we need to determine, okay, when was the first day that they were in the United States? Because there's a rule that you can actually exclude up to 10 days from the beginning of someone's residency date. In your example, where you have someone coming in on March 1st, say that they came to look for an apartment or a house in February, and they were here for only 5 days. Although they were here earlier, before March 1st, because that trip that they had in February, it was less than 10 days, and we can exclude the entire all of those days in that trip. Their initial residency start dates would be March 1st. It wouldn't go back to February. However, if you have someone come in February for 12 days and before they actually moved to the United States in March, and they went house hunting, and maybe they also, I don't know, did some sightseeing or whatever. Maybe they spent 12 days looking for an apartment or a house. So the residency start date would be in February, not March.
And if we're counting in the preceding years, the 1/2, the 1/6, etc., it's still the same calculation. It's just in that particular tax year in question, the first date they stepped foot in the US, or allowing for the 10 years. So the fact that they might have spent previous days in the US that contributes towards the day count in the relevant year, that doesn't matter.
And if they do meet the substantial presence test because of previous days, then the beginning date would be January 1st.
Fine, okay.
It's just the first year.
The first year, okay. Oh, that I can see how that makes sense. And see, in the UK, the default is if you trigger tax residency status in a tax year, you trigger it for the entire tax year.
Oh, I see. So it's like April 1st or whatever.
Exactly. So in theory, if you came in March, but for some reason, the reason you triggered tax residency status was such that you were a resident from March 1st, despite the fact that you are 11/12ths of the way through the tax year, the UK would actually look to backdate your tax residency status at the beginning of the tax year on April 6th and say you're a resident for the entire year. Now, we do have what's called a split year test, where you can, in certain circumstances, carve the year into a non-UK part and a UK part, but you have to be eligible for it and you have to actively claim it. If you don't do both, or you don't have both, by default, you can have your residency status backdated by up to 12 months to the start of the tax year in which you claimed residency status for the first time. So it's interesting, again, the US appears to be more, and what I'm getting from this is the US does in fact appear to be more generous, because the test I think is also simpler, is more generous with the way in which it applies, which I think is really, really interesting, because I think when we talk about taxation, frequently the Americans often are the ones who appear to be the more draconian, or the one where they allow less wiggle room compared to the UK. But here, the US actually appears to be the slightly more generous party.
Okay, well, good to know.
Look, this is, I think, really, really helpful. I think the substantial presence test and the day count is something that I think does confuse quite a lot of foreign people when they want to come to the US. Just so I know, in your mind, or in the tax code, or in the professional community, do you have a way of distinguishing between people that are US tax resident by virtue of being citizens or green card holders, and people that are US tax resident by virtue of triggering the day count test? Or do you just refer to all of them generically as US residents? Is there any way of distinguishing?
No, so basically we refer to them in our profession, in our industry, as US tax residents. But obviously when we get to talk to the client, we understand who is a US citizen versus a green card holder versus just someone who meets the substantial presence test. And that's usually done, determining who they are and what they are It's usually done in the beginning when we intake the client, because we need to determine.
Colloquially, when we deal with clients in the UK, I'll frequently come across clients who say, well, I'm a US resident and I'm a UK citizen, or I'm a US resident, and et cetera, et cetera. And my brain goes, I'm assuming what you're telling me is you are physically present in the US and you are a US resident. You are not distinguishing between immigration and tax status. You're just telling me you live in the US and are triggering US tax residency status by one of those metrics, but I'm not really going to distinguish between the two of them. But it's a generic phrase that people say, oh, I'm a US resident, in the same way they'll say, I'm a UK resident. And I'm just inferring from that they are physically situated in the US. There is no way, there's no clever secret word I get to use where I get to distinguish. They go, aha, what you actually mean is you're a citizen.
I mean, basically, we find out as we talk more to the client what they mean, because sometimes some clients would say something. So, for example, they use a lot of clients use domicile.
Yes.
They say, "Oh, I'm domiciled in, I don't know, XYZ country,"
Yes.
and you're like, "Okay," and you kind of know that what they mean is that they live there, because
Yeah.
also domicile in Spanish. We do have a lot of Spanish speaking clients. There's a word called domicilio, which really means an address. My address is at XYZ country, right? Or in this country. So when they say I am domiciled,
You know what they mean.
understand that's where they live, but we always ask, because we need to make sure that that's what they mean. And it's not just Spanish speaking clients; it's all, like, a lot of clients use domicile, and it's like, okay, let's clear that up, because we want to make sure that we understand what you mean by that word.
I mean, the UK was a big contributor towards that confusion, because for many years, until very recently, we assessed both to residency and domicile status. As it is now for tax purposes, we've largely put the domicile question to bed.
Yes,
but
yes.
we're now largely a tax residency tax code. But yes, I'm entirely familiar, and you're right. When someone says, well, I'm a domiciliary of the US, you go, yeah, you probably are, because you're a citizen. But you don't mean domiciliary, you mean a resident, but that's fine.
Yes. I mean, we do use domicile for estate tax purposes.
I will share with you one thing. To the listener, we'll see whether this bit gets put into the recording or not. But I've been spending quite a lot of time looking at the capital taxes treaty that we have with the US. And there's a phrase used in the capital taxes treaty that no American practitioner has actually managed to explain to me what it means when it's talking about whether someone is a domiciliary of the US for the purposes of the treaty, where it talks about someone being a US resident brackets domiciliary. And I say to all these American advisors, what is a US residence domiciliary? Do you mean a US citizen? Do you mean someone who passes the day count test? I've never heard of this phrase, US resident brackets domiciliary, and really it's rather confusing.
It is confusing, but I would take a stab and think that it's a U.S. citizen, because they are the only ones that would be domiciliaries. I mean, maybe not the only ones, because green card holders could be as well,
Yeah.
and even people who don't have a green card. But
if we go further down the rabbit hole, and this is where we start to get really niche, and you see the sorts of things, dear listener, that Alicea and I have to deal with quite frequently. The rule actually says you are a US domiciliary for the purposes of the treaty if you are either a US resident domiciliary, or you are a US national and you've been a US domiciliary in the last 3 years. So it can't be nationality or citizenship that defines domiciliary. It's very confusing. And if anyone has an answer to that question, I'd really appreciate it, because I've actually got quite a few clients with an answer to that question. What I would love to turn to now, if we can, is perhaps a seemingly trite question, but actually a really quite important question, which is, so we've spent a lot of time talking about whether someone isn't a resident of the US, but what does it actually mean? What are the consequences of being a US tax resident? Because in this world of citizenship, obviously many Americans, it doesn't really matter, because they are just exposed to taxation, and so the US is always going to tax them. But for sort of those that are triggering the day count test, fundamentally speaking, what is the difference going to be between being a non-tax resident and being a tax resident of the US on their exposure to income tax in the US?
Yeah, sure. No, that's a good question. So basically, a non-resident who doesn't meet any of these tests that we discussed would only be subject on U.S. taxation on their U.S. Source income. So say if they work in the U.S. or they spend a few days in the U.S. working, that would be taxable. But for someone who's a U.S. citizen, green card holder, or meets the substantial presence test, so they are all tax residents, U.S. tax residents, they are subject to worldwide taxation. What that means is that even if they move overseas or to Mars, anywhere they go, they will still be subject to complying with the U.S. tax laws, which means they will have to file income tax returns and not necessarily pay U.S. taxes, because it's possible that they may have a credit or somehow some of the income may be excluded from taxation, but they will have to file that paperwork. They will have to file a tax return and give it to the IRS, submit it to the IRS. And then also not just tax, but they may also have to file a foreign bank account report, which
Everyone's
is
favorite part of the compliance
yes,
exercise.
yeah. And so that's, as you may know, is a report. It's an annual report. It goes also by a calendar year. So you report, or U.S. tax residents report their non-U.S. financial assets. So if the aggregate amount exceeds $10,000, so what accounts? So checking accounts, savings accounts, like insurances with cash values, retirement accounts, pension accounts, all of those things, right? But then also, now with the advent of FATCA, a lot of Americans who live overseas are having a hard time opening accounts overseas. And it's very hard. They make it very hard. Other countries make it very hard for them to open accounts overseas because they don't want to comply with FATCA. It's too expensive. And if they have one US person that needs that reporting, then they need to do that reporting for, they prefer not to do it. So they just prefer not to open their doors to Americans. So it's a problem. It's a problem, to be an American overseas or even in the US, because you're subject to worldwide taxation.
As someone who spent almost 30 years as an American citizen living in the UK, sorry, I can definitely attest to the complexity of trying to open bank accounts or trying to assess what the highest value of your mortgage was in a calendar year for the purposes of your FBAR. Alicea, I'm sure there's a lot of Americans who listen to this who would think, yeah, I've had that problem, and I promise you, I'm damned if I don't because I can't open a bank account, and then I'm damned if I do because then I've got to report it on my FBAR. Now, the other thing I think that's important to sort of to reflect on or to question is, you said there that the moment you become US resident, you're exposed on a worldwide basis. There is no easy landing. There is no de minimis level in the first year. There is no sort of tax-free incentive like we now have in the UK. We have a 4-year rule that says for the first 4 years you live here, we'll give you a lighter tax burden where you can avoid paying UK tax on your foreign sourced income and gains. In the US, once you become a resident, you are inside the club. You are paying tax from day one. Is that correct?
You are inside the club from day one. I mean, we do have filing thresholds. So those depend, they go up every year by inflation. And we have filing statuses. So in the US, we file single, we can file jointly with our spouse, or we can file head of household, or married filing separate. So every one of those statuses has their own filing threshold. So if you meet that filing threshold, meaning that if your income is more than that filing threshold, that for that one calendar year, which is the tax year, then you would have to file a tax return. And it's possible that's because of many of credits and other deductions you may be able to take. You may not have to pay taxes because at the end, maybe the result is negative or zero. But in order for you to take advantage of those credits and those deductions, you need to file a return.
Yes. But there's no grace period. There's no introductory level. It's funny because in the UK, I don't know how you see it in your practice. In the UK, we have people who say quite frequently they're very surprised that they come to the UK and, after only 4 years now, gosh, well, we're going to be subject to taxation on a worldwide basis. I think that doesn't seem that unusual. The Americans don't even give you 4 years. You don't get anything in America I mean, let alone if you're a citizen, you can live overseas and have that exposure. But if you go and relocate to the US is going to expect taxation on everything from the moment that you become a tax resident. So again, that's one maybe where the UK is slightly more lenient.
It's a good time to go to the UK. Well, not really for Americans, because it doesn't matter where we are, where we go, we're still going to have to pay or file tax returns. But it's possible, I mean, maybe, let me take a step back, because say an American moves to the UK, the first 4 years and they're working there and maybe they get a salary or they're self-employed, they can exclude up to a certain amount. I think it's $130,000 for this year for 25 under the foreign earned income exclusion. So maybe up until, up, and then maybe there's some housing expenses that they can also exclude, but let's take just that amount. That won't be subject to tax in the US and not in the UK either, because they have that four-year holiday, tax holiday.
Regime. I think the formal word is regime. But yeah, it's a tax vacation, to use your word. The balancing factor is that, and it's been my experience of the US income tax code, that the US income tax code is much more generous with reliefs, deductions, exemptions, and credits that you can use to bring your tax down, whereas the UK is much less generous in what you can deduct against your gross income. So you end up paying a higher rate of marginal tax in the UK because you can't deduct as much off it. But if you're coming to the UK for the first time, we will at least give you 4 years. So it's sort of horses for courses, as we say in the UK. It probably evens out overall. The other question that I want to ask you, if I may, is we, of course, have been talking about tax here and US tax, but what we're really talking about is federal tax. Of course, there is, and I'm not going to ask you to go into all the territories of the US, Alicea. I think we'd be here far too long. But I just want to point out that it is worth noting separately that if someone, let's say you are currently sitting in New York, if someone is moving to New York, we've talked about federal tax consequences, but that person moving to New York has to think about New York state consequences and maybe even New York City municipal or sort of city level taxes. So there is an entire secondary layer of complexity of state level residency rules and state level consequences of being resident that one has to deal with underneath the federal rules, correct?
Yes, exactly. So in the US, we have a whole bunch of different kinds of taxes. We have for an individual, we have income taxes, and we have income taxes at the federal level and also at the state, local level as well. So, like you said, in New York, we do. So, and by the way, not all states have an income tax. So that's another thing.
There are many New Yorkers who've relocated to Florida for, I'm sure, the sun and absolutely nothing to do with the income tax code.
Yes, many New Yorkers and many other people who have relocated from high tax jurisdictions like New York and California, because in New York and California, we have the highest state income tax rates in the United States. And after the pandemic, a lot of people moved to Florida. A lot of people moved to Texas and other states that have no income tax, no state income tax. I mean, a lot of them actually moved back because Florida is not New York, obviously.
No, this is true. This is true. To each their own, but there are differences between Florida and New York.
Yes, these states don't have an income tax, but New York and California and other states do. And actually, even within those states that have an income tax, some states would vary, right? Some states, for example, New Jersey has an income tax on gross income. Oh my God, what is gross income? I mean, they don't allow your deductions, and it's like, oh, it's another world, right?
Spoken like a true New Yorker, by the way, Alicea. I'm just going to say, putting down New Jersey. I commend you.
Yes, New Jersey. I mean, it's right next door. It's not New York. It's another tax world. And also, say New Hampshire. I mean, I think they only tax interest and dividends, and that's it. They don't tax salaries, wages, etc. So all of these states, some of them may have an income tax, but the rules may be different. From the federal rules, meaning that they tax different things.
And as a general rule, I'm going to speak very generally here because I'm not expecting you to be able to comment on every single jurisdiction inside the US. I mean, we've discussed how you can be a federal income tax resident for lots of different reasons. You're a US citizen, for example, living overseas. As a general rule, are you only going to be considered a state resident if you are actually physically present in the state? I have heard news previously of clients who have been told you are still a California tax resident despite the fact that you don't live in the United States anymore. So you are a state resident, but you are no longer a federal resident. I mean, is it generally the case that if you're not living in the US, you're probably not a state resident? Or is it actually a bit more complicated than that and you do have to check quite carefully?
Yeah, so it's complicated. So every state has their own.
I'm surprised.
Every state has their own rules. You could actually be a resident of more than one state. and then the states fights over you, right? And you have to fight them as well. But anyways, every state has their own rules as far as who is a resident and who is not, or who breaks residency. Usually, for example, New York, they want you to land and lease. What does that mean? That means that if you say that you're leaving New York, that you actually landed somewhere else and that you're actually a tax resident somewhere else. You're not just like a digital nomad. You need to have, landed somewhere else. And they will ask for proof. Actually, after the pandemic, New York did come out with a mandate to audit everyone that claimed to have left New York. So if you filed, say, a part year return, because you could file a part year return for someone who may have been in New York for the first 6 months of the year, and then they left and moved somewhere else, and the last 6 months they were not in New York anymore. So they would file a part year New York return, and they would get audits, and the audits would include, okay, we want to know, we want a copy of your lease agreement at the new address or whatever, your new job, your new driver's license, all of that stuff. But, New York is very aggressive. They don't like people leaving New York. You have to be careful with the rules
Yes.
of the state.
That actually takes me quite neatly onto the next thing I wanted to talk about, which was leaving. Because, of course, maybe you don't want to be a tax resident anymore. Maybe you've decided that Uncle Sam has had enough of your time and your money. And so this is no longer where you want to be. I presume, on a substantial presence test basis, it's quite straightforward. You just stop being substantially present in the US. And I know this is a whole separate topic, and we have actually looked at some of these issues before in different episodes about renouncing citizenship, etc. I just wanted to take the time and maybe a couple of seconds to have the opportunity to discuss with you that if you do want to cease to be a US resident because you're giving up a green card or because you're giving up citizenship, there are other tax consequences that can come with that decision. It is not as easy or as simple as just saying, I'm giving back my passport, or I'm just going to tell the IRS I'm no longer using this green card. There are hidden tax consequences to that process, aren't there?
Yes, and actually, it's like that Hotel California song. You can come in, but you can't get out. So it's going to be difficult. They make it very difficult for you to leave the United States. So if you are a U.S. citizen and you want to renounce your citizenship, there's an immigration side of things, and then there's a tax side of things. And I think, and I'm sorry for those immigration practitioners out there, but I feel that the tax side is more complicated.
It's fine. This is a tax podcast, Alicea. We're both tax advisors. It's fine. I think we're on safe ground here. It's fine.
So there's an immigration side of things. You need to do something on the immigration side, but then you also need to do steps. You need to do some steps on the tax side of things. And on the tax side of things, it gets complicated because you have to file special information returns forms by a certain deadline, and it's possible that you may be considered what we call a covered expatriate, meaning that it looks at three tests, and if you meet one of those three tests, then you are already a covered expatriate, and a covered expatriate is a bad thing because you are going to be subject to an exit tax, which it could be manageable. We could plan, if there's time, plan for you to minimize that tax or avoid it.
But you don't want to do it accidentally and inadvertently and not realize that you've done it.
And many people have done it, right? Especially maybe not on the U.S. citizen. Like people who renounce their citizenship usually do seek help. But on the green card side of things, people either they may send it back, or they let it expire, and then they think, oh, I'm no longer a green card holder, but then they are. So there are ways that we need to clean that up, right?
But the expatriation event with handing back a green card, is it the case that I have to have held the green? Is it for 8 or more of the last 15 years before I have to worry about being a covered expatriate?
Yes. So for a green card, so a U.S. citizen,
always the case.
Always may be a covered expatriate without looking at the time that they've been a U.S. citizen. Now, green card holders, we need to look at how long they've had the green card before they gave it up. So yeah, if they've had the green card for 8 out of the last 15 years, they will be considered long-term residents, which they could also be potentially a covered expatriate subject to that exit tax. then this becomes a whole total new subject. Then I mean, it's wonderful. I love it. It's a delicious topic. I love this topic. And unfortunately, I do have a lot of clients who are expatriating, and you can actually, there's a list, and I always forget the website, but every year they publish a list of all the people who have expatriated.
Oh, I didn't know that. So I expatriated in 2020. I expatriated in 2020. Does that mean that my name is on some list somewhere? Oh, if
So wait
anyone's
a
listening
second.
wants to go and find it.
You're no longer a U.S. citizen?
No, I gave mine up in 2020.
Okay, so your name is out there. Yes, you should double check that list.
Oh, I did. Oh gosh, I don't know how I feel about being on a list.
Yeah,
Oh,
they
I
want to
suppose it-
shame people. Shame people.
Look, yes, that is an entirely separate topic, and clearly what everyone can hear or see, depending on how they're listening, Alicea, is if anyone wants to get in touch with Alicea and talk about their circumstances of expatriating or renouncing their green card, Alicea will be only too happy to talk to you because it clearly is one of her favorite topics.
I don't know when this is going to come out, but I'm giving a presentation on expatriation at the STEP Colorado. So I think it's next week.
We won't get this out, unfortunately, that quickly. But what this will mean is anyone who is listening to this that was at STEP Colorado will be able to hear and recount how good it was. Or for those that it has passed, will now need to make sure that they wait for the next time that Alicea is speaking, because I know you well, Alicea. This will not be the last time that you speak at a conference. You are a regular speaker at many conferences, from my own experience. What I would like to just touch base on and finish at the very end with here is the thing that we have been teeing up a couple of different times, or we've been sort of teasing people with over the course of this episode, which is, well, of course, there are circumstances where two different tax jurisdictions are going to try and tax you at the same time. And for these purposes, let's talk about the US and the UK, not California and New York, or the federal US tax code and the state US tax code. But let's talk about two different sort of countries trying to tax you. Because, of course, as you pointed out, it is entirely possible for someone to be a US resident and be a UK resident at the same time, either because they spend 6 months of the year in the US and UK, or they're a US citizen but live in the UK. By some fatal design, they are ending up being treated as a resident of both countries at the same time. And so we have this double tax treaty that says either on a kind of line item basis, well, the UK has the right to tax this first and the US must give a foreign tax credit, or vice versa. But actually what I think a lot of people don't realize is if you are someone who is triggering residency in both countries, you may be able to be treated as what's known as a treaty resident. The US and the UK have a series of tiebreakers that say in certain circumstances, if you are genuinely triggering, say, the substantial presence test in the US and the statutory residency test in the UK, that you may be able to find that one country has to actually concede and treat you as a non-resident, and the other country then is still allowed to tax you as a resident. And so we have, I don't know in your experience, Alicea, with people coming to the US, but certainly with Americans coming to the UK, we do sometimes find that maybe in that first year, maybe that second year, that actually they can find themselves triggering our UK domestic residency rules, but actually still being eligible to claim US treaty residency status under the US-UK double tax treaty and actually get out of quite a few of the consequences of being UK tax residents. Do you turn to that sort of provision on any US tax treaties that you have with other countries to try and alleviate the burden of US taxation for those coming to the US?
Yes, we do that. So we take a treaty tiebreaker position and on many of our clients' returns, and sometimes it's more than one time, I mean, 1 year. We have a client and we've already warned her that she needs to stop doing this because but what happens is when someone takes a treaty tiebreaker position, there's paperwork that needs to be done, right? So there's the non-resident return that needs to be filed with a form 8833, which is the treaty, position return that needs to be a form that needs to be included. And there's an explanation that needs to be included. But then also the 1040NR, there's a question on the 1040NR that asks you, have you taken a treaty position? I mean, I'm just paraphrasing, but then it asks you, if you have, what is the article that you've taken? What article did you take? What treaty position did you take? And then also, how many months did you take that treaty position? And so we have this one particular client has taken this treaty position for 11 years.
Oh, wow, that's a long time.
So the months are huge, And so we've already said, okay, we cannot do this again. You need to just stop. Do not come to the US, just stay away.
What I say to clients, and I imagine on the day count basis, on the substantial presence basis, you would presumably say the same thing, which is if you want to avoid the consequences of being UK tax resident or US tax resident, you can either not trigger the domestic rules in the first place, or you can trigger them but try and rely on the treaty to claim a tiebreaker position in the other country. The problem is, or the benefit is, if you want to avoid being a resident, the substantial presence test and the statutory residency test are both black and white tests. They are clear, objective tests. You know if you haven't passed it or not. Whereas the treaty tiebreaker rules in certainly the US-UK treaty and a lot of OECD model treaties is a subjective test. You are seeking to persuade the IRS or HMRC, for example, you're seeking to persuade them, this is my position. I consider myself to be a US treaty resident because my facts tie break to the US, and you're basically inviting HMRC to disagree with you. And they can choose to disagree with you because it's a subjective test, because the tests are not objective in nature. So all things being equal, better not to trigger the domestic rules in the first place rather than try and rely on the treaty. The treaty is a good secondary option if you've got no choice, but better to avoid residency status by just not
I would
triggering.
agree with you, yes.
Yeah, that's the takeaway. Take the advice first. Make sure you plan in advance because it's better to not trigger the rules in the first place. But also know, if Alicea and I haven't reassured you over the course of this episode, there may still be sort of get out of jail cards, or there may still be reliefs or caveats or exemptions that you can use to wear down some of the sharp edges of the tax residency rules. And, you know, take that advice before you do it, because if you've been in the US for 190 days and then you come and see Alicea, she's going to say to you, well, you should have come and seen me 190 days ago because I could have helped you at that point.
Yes, exactly.
Thank you so much for coming on today, Alicea. It's been really, really wonderful to have the chance to talk to you. And
Oh, thank you.
I'm sure,
No, it was fun. Thank you.
yeah, everyone can see how knowledgeable and well-versed you are on this topic. If people want to get in touch with you or want to find out more about your practice, how can they find you?
And they can go to www.globaltaxes.com. And it's not Global Texas. Some people think it's Texas, but no. Taxes. Or they can email me. They can email me at Alicea, ALICEA, at globaltaxes.com.
Wonderful. And I also know you are a prolific LinkedIn and networking and marketing guru. So I'm sure if people just Google Alicea's name, I would be staggered if you don't find large amounts of information about her. Alicea, thank you so much again. It's been a real pleasure.
Thank you. Thank you so much.
Thank you for joining us today on the US-UK Tax Talk podcast, and a particular thank you to Alicea for being my super guest. A reminder that we release episodes on the first Wednesday of every month, and so make sure you like and subscribe so you don't miss an episode. Please also check out Colibristo's YouTube channel, where you can now find all of our most recent episodes in video form. Thank you so much again for joining, and we'll see you next time.